Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's guest is the CEO of Strategic Resources, a critical mineral development company focused on becoming a supplier of green steel inputs. Sean Cleary, welcome to the show.
Thank you, Jesse.
Now, before we dive into green steel, I want to take a step back and get your view on the current macro setup when it comes to iron ore, pig iron, and the iron industry as a whole. What should investors be paying attention to in this sector right now?
Well, really, the biggest thing to pay attention to right now is the speed of transition for the steel industry away from, traditional blast furnace steel making towards electric furnace steel making. This is a major in our lifetime significant change in what's going to happen for steel inputs. So these are the raw materials that are used to produce steel globally. And especially, investors should be focused on the major markets in the Western Hemisphere, being the United States, North America, Europe, Middle East, where we have massive changes going on in the steel market. And that has very significant underlying issues for everything from iron ore production all the way through to, ore-based metallics. So metallic type of iron that is used in electric furnaces. Electric furnaces are generally recycling furnaces that run mostly on scrap. Scrap steel is what is used. And, the thing about steel is that you can recycle steel. Electric furnaces are designed to recycle steel. And when electric furnaces use steel as an input, that is a significantly lower carbon footprint per ton of steel than what traditional steel making is. So, governments in the Western Hemisphere are very much focused. In Canada, where I'm based, we have significant steel manufacturing plants that are under transition right now, moving away from blast furnace to electric furnace. And our company is focused on supplying those inputs that are required. So, because when you make steel in an electric furnace, you're not just using scrap, you're also using what the industry calls ore-based metallics. So other types of metallic iron, which, because, the problem with scrap is that scrap has contaminants in it. You think of, a scrapped car, there's, all kinds of different contaminants when you crush down a car and then use that to manufacture more steel. Those pollutants need to be diluted out of the, so that the steel producers can hit spec. And the way they do that is with either directly reduced iron, hot briquetted iron, or pig iron. So, you add those to the steel recipe, and those are the products that we want to produce and supply into the market.
That's a great breakdown. Could you give us maybe some more color on the supply-demand fundamentals when it comes to iron, when it comes to green steel inputs, just so people can kind of wrap their heads around the market a little easier?
Iron ore, the mining of iron ore is, I think the seaborne market is something like 1.5 billion tons a year now. So, we're talking about a major market. Iron ore would, typically trade in around $100 a ton. And, iron ore is processed into, further processed so that it can be used either in a blast furnace or an electric furnace to make steel. And, in the case of, electric furnace, iron ore, which is iron oxide. So it's the oxide form of iron. In order to use that iron to produce steel in an electric furnace, you need to turn it into metallic iron. So instead of FeO, it's got to be Fe in chemical terms. And so that is done through a couple of different processes. The most efficient from a cost perspective and from a emissions perspective is to directly reduce that iron. Okay, so in order to directly reduce iron, you need a very high purity form of iron. So what you're seeing right now is a lot of producers in the iron ore business that are miners are focused on producing, higher, more pure concentrates, so that those concentrates can be used for directly reducing iron. And today, out of the 1.5 billion tons or so of iron ore that are produced, you have something like 140 million tons that go into DR furnaces. So that's the portion that gets directly reduced, and that's the portion that's currently going into electric furnace steelmaking. The industry expects that that's going to grow significantly. So some estimates say that, by 2050, the amount of DRI that will be needed will be, more like 400 million tons. So, 3.5 times what we are today. And that is a significant investment by the industry that supplies into the steel market to be able to do that. So, we see that growth coming in the next couple of years. It's expected that high purity iron ore part of the market will be supplied. But the pellet capacity, because you have to pelletize the iron ore in order to directly reduce it. So the pellet capacity right now is a little bit of the bottleneck. So for our phase one of our strategy is to install a 4 million ton a year pellet plant at Port Saguenay in Quebec to address what we see as the significant supply deficit that's coming in the high purity iron ore pellet market. So that'll be step one. And then step two, we're also permitted to install a direct production furnace at the industrial park at Port Saguenay, where we have a long-term lease. So that'll be our phase two. We've also permitted a mine in Quebec. So we'll eventually integrate the overall operation so that we're supplying our own pellet operation and our own DRI operation. And by the end of phase three, we'll also be able to produce pig iron. So we want to be able to produce pellets for the market, directly reduced iron for the market, and pig iron for the market, essentially fitting right into being a solution provider for that part of the market that's going to have a deficit in the next number of years, and that's really supplying, the push by government and industry to reduce CO2 emissions within the steelmaking industry. So that's what we're all about.
Well, I want to talk about vanadium now, another commodity that Strategic Resources is involved with that doesn't get a lot of coverage. So what are the main use cases for vanadium, and why should investors be watching the vanadium market?
Well, vanadium is another very important mineral that's used in the steelmaking industry. So around 85% of vanadium production goes into steel production. And, it's a ferro alloy. So it's an alloy that's used in steelmaking to increase the tensile strength of steel. So in simple terms, if 1% of your steel recipe is vanadium, you will double the tensile strength of your steel. And, overall industry is interested in that for certain high strength steel specifications, but also because when you increase the tensile strength of your steel, you can use less steel to accomplish the same, objectives in either construction or automotive. So you can reduce the weight of either, an automobile, or you can use less steel in your construction and, rebar applications, et cetera. So, basically, governments around the world, China, I think, just announced that their spec for rebar is going to require more vanadium. So from the major consumer of vanadium, it seems like consumption is going to go up because of that. But vanadium is also used as a battery metal for grid level battery storage. So for wind and solar, or remote locations, vanadium batteries are used. These are very large, like basically the size of a container type batteries that are used to store energy during peak times, and then put it onto the grid, onto the electrical grid. When demand is up, but production of electricity is lower from either solar or wind. Those battery installations are growing significantly, especially in the Asian market today, but we expect that that's going to grow significantly within the European market, as well as the North American market over time. So, and the issue with vanadium supply is that the majority of vanadium is produced in China, Russia, South Africa, and Brazil. So we don't have a lot of vanadium production in Europe and North America. So part of the mineral contained in the Blackrock project, which is our project in Quebec in Canada, is vanadium. So we could become a vanadium producer. And we also own a former vanadium iron mine in Finland called Mustavaren. So that's a brownfield location, which is strategically located for the European market. So we could also become a producer of vanadium for the European market. And processing plants in Europe and the United States are being starved of high quality vanadium feedstock because of the disruption, what's going on between Russia and Ukraine, but also, just the overall, I would say, industrial climate in South Africa is really hurting production. So you've seen a number of producers go offline. There's a situation where the market is expected to have considerable growth in consumption, and we really don't have the line of sight on where that supply is going to come from today. And Strategic Resources owns two of the most, advanced, well-developed, well-understood vanadium resources on the globe.
You brought up China there, controlling so much of the vanadium supply. I wonder what your thoughts are on recent export restrictions by China to the United States of some rare earth elements. Do you think we could see that sort of resource wars ramp up, where more nations are going to be restricting exports of certain commodities to non-friendly nations? And does that underscore the importance of securing domestic supplies for some of these critical materials?
Yes, I think is the case. It's not just, the governments and the politics of it. I would say it's also just, consumption, use, and the economics of it. So, for example, one of Russia's largest producers of vanadium, which used to, they still supply some of the vanadium that goes into the European market, for example. They've announced that going forward, most of their vanadium is going to be used internally in the Russian market. But, I don't think that's necessarily just a political move. I think that's just the necessity of the situation. They have so much vanadium production. They have so much vanadium requirements. They're going to use that internally. And, it's probably a similar case in China, where, their industrial base has grown so rapidly over the last, couple of decades that, now they need X amount. And so they produce, so much, and they're going to use it. And then, of course, you have all of the what's coming in terms of tariffs and trade wars and, CBAM, in terms of like carbon taxes. And so the world is rapidly evolving in all of these areas. And I think suppliers at the end of the day just want to sell to, the best price and the best market and the easiest, logistics in terms of, getting the supply there. So, I always look through like, the grandstanding politics of all of this and say like, okay, well, where are the customers and, how much supply do they want? There's no question that Europe and the United States, North America, have a problem in terms of feeding what their consumption requirements are going to be for these, critical elements. Two of the ferroalloys that we'd like to produce, being vanadium and titanium, they're on Europe's critical mineral list. They're on Canada's critical mineral list, the U.S. critical mineral list. NATO just put out a critical mineral list. Vanadium's on it. So like, I think everybody recognizes that consumption is going to grow, and the supply and, the investment into the mineral producers in the Western world is nowhere near what it needs to be in order to address that, deficit that's going to come in the market. I think government's intervention, in places like China, they have more, they have their hand on the steering wheel in terms of where investments go. And they're looking out a little bit further, and maybe within their own market, they're already feeling those constraints around, the supply area. So their willingness to invest, seems higher than what we have in the Western world, where, just look at, the S&P over the last 12 months. Where's the action? It's all on, high tech companies and, big industrials, but it's not really focused on the underlying supply chains of minerals that are required for the production of products. And this is where I do think that we are going to see a supply squeeze on certain elements as we go through the next decade or so.
Well, let's now discuss how strategic resources fits into the picture. You've given us some hints of your operations thus far. Maybe you could dive a little bit deeper and provide an overview of the company.
Yeah, sure. Happy to do that. So we're listed on the Toronto Stock Exchange, the venture part of the Toronto Stock Exchange, under the symbol SR. We have a market cap of roughly 40 million Canadian dollars. We are very well sponsored. So we are 40% owned by the Quebec government, so the investment arm of the Quebec government, called Investissement Québec, and 40% by Orion Mine Finance, which is one of the largest mining and metals private equity groups in the world, based out of New York, as well as the Lumina Group has a significant ownership piece in us, which is Ross Beaty Development Company based in Vancouver, and the Cree Nation government are also shareholders in the company. So we have a good group around the table for our firm. We have two development projects, one in Canada and one in Finland. The Canadian project we call the Blackrock Project. It consists of a fully permitted mine and concentrator located near Chibougamau in Quebec, so that's the middle of the province. In that mining concentrator is connected by rail currently. So the mining concentrator to be built, so it's permitted to be built. Pit 1 has a 30-year mine life, would produce 1 million tons of VTM ore per year, which is 62% iron, 1.4% vanadium, and about 9% titanium. And we would produce that, concentrate, ship it by rail down to, we've got a leased industrial park at Port Saguenay, which is about 350 kilometers south of Chibougamau. And at that site, we have three phases to the metallurgical plant that is permitted at Port Saguenay. Phase one will be the installation of the iron ore pellet plant. So we'll ship in high purity iron ore by boat. A conveyor is currently being constructed at the site by the Port Authority. So this is a federal public port as part of Ports Canada, and it's a deep sea port on the east coast of Canada with access to St. Lawrence. So we can ship out to the seaborne market, and we can ship down into the Great Lakes as well from this location. And so phase one will be the pellet plant. Phase two will install the permitted DR furnace, direct furnace, and produce DRI. And then in phase three, we'll install an electric furnace and also produce pig iron, as well as the two ferro alloys that I mentioned earlier. So by the time we develop phase three of the overall project, we'll have 5 different revenue streams. And then in Finland, we have a similar, very, very similar project, which eventually over time we would like to develop or partner to develop and supply mostly the European market. Back in Canada, and why we're focused on the Canadian project as sort of the first objective of the company is because at Port Saguenay, so Saguenay has access to natural gas, and the iron producing region in Canada does not have access to natural gas. There's no pipeline there. So when you want to produce high purity iron pellets and directly reduced iron, you need access to natural gas. That's the lowest cost and best way and lowest carbon footprint in terms of producing these iron inputs. And so importantly, Port Saguenay is strategically located near natural gas, and we have very low cost hydroelectricity in Quebec. So this is, both a cost element as well as a carbon footprint element of producing really good product for producing greener steel. That's what the market wants. We see CBAM coming into effect over the next couple of years in Europe, which is really a tax on your carbon footprint. So we'll be able to produce a lower CO2 per ton product, like significantly lower than what our competitors could produce in the Canadian market, and the European and North American market. So we believe that we'll be able to produce a very high purity and very attractive product for the market. And we expect that, the industry expects that this market's going to be in deficit in the next couple of years. So we'll be supplying into a market that will readily accept our product. So that's where our strategy is. That's our focus. And, we think we have a sustainable competitive advantage because of our access to natural gas, and the availability of natural gas and the price of natural gas in the Quebec market is very good.
Well, talk to us about the Quebec government being a 40% shareholder in the company. Does that provide any advantages in terms of faster permitting times? And what are some of the kind of key elements of that relationship that you find is providing an advantage to Strategic Resources?
I think I think, look, we have to go through all of the rigorous environmental and permitting requirements that any project has to go through. I think, having significant ownership from the Quebec government provides a level of credibility to our team and the project and what we're doing. And, it certainly is very helpful. But in terms of environmental requirements or, requirements that are necessary to obtain permits, we have to go through all the same public hearings. the same environmental assessment studies. This project has been, years in the making. So I've been working on this project since 2011. So like this is not something that can be created overnight. And that's, I think, people from the outside the industry looking in maybe don't quite appreciate how long it takes to, move things within the mining industry and within, steel production. These are big investments, and the environmental scrutiny around the industry is very, very significant. So we've gone through all of the public hearings. We've been very fortunate because we're in an area in Saguenay that is an industrialized area. It's the major center for Alcan, which is Rio Tinto's aluminum company. So you have many plants in this area. And when we went through environmental hearings and the public procedure for getting approval for this project, we had no objections from any group or individuals against this project. So, and we were, also supported. I think it's been helpful. We've been supported by First Nations groups that are in the area. So we have development agreements with 3 different bands of Innu First Nation groups in the area, as well as we have a full impact benefit agreement for the life of the project with the Cree Nation. So we've worked closely with those groups. We've worked very closely with the municipalities. We have cooperation agreements with all of our municipalities. So, I think when it comes to, that kind of government ownership that is part of our company, it's been just helpful to get groups to sit down. We're a small company, but, they'll sit down with us. They'll take us seriously because of, the sponsorship that we do have.
Yeah, that makes a lot of sense. Could you talk about the supply and offtake agreements with Javelin Global Commodities that you recently signed, and break down what that means for the company?
Yeah, Jesse. So a couple of weeks ago, we completed, after months of negotiation, definitive agreements to supply the pellet plant at Port Saguenay with pellet feed. So that's an iron oxide high purity pellet feed of a little bit over 4 million tons per year. And Javelin Global Commodities, which is a major commodities player based in the UK, has is our partner on that, our supplier on that. And they, as part of that agreement, they've also agreed to purchase 100% of the pellet supply coming out of the plant as well, on an agency basis. So they have certain clients in the steel market, and so that supply will go to their clients in the steel market. And then what we were able to do in terms of working capital facility. So Javelin has also put forward a term sheet to provide the working capital required to operate the plant. So that's $150 million of financing for working capital once we're in operations. That will also be provided by Javelin. So they're going to be a major and important element for the operations of the plant itself. And today, what we're doing is, in order to complete the final steps of engineering and detailed engineering for the plant, and sort of the final feasibility for the plant, we're currently arranging to send to Metso. So Metso is the OEM for the pellet plant itself. So we're sending to Metso, and we're working closely with Metso on the design of the plant so that we can test a number of different sources of pellet feed, and to basically optimize that plant design for those pellet feed sources. So that's what we're working on today. We hope to have that completed in around early Q3 of 2025. So near the end of Q2, beginning of Q3 of next year. And then we'll be in a position to make a final investment decision in around that time to move forward with the pellet plant project in Quebec.
Well, I will end by opening the floor to you. Is there anything we haven't yet discussed, or maybe some things you want to emphasize to potential shareholders of Strategic Resources that you think is important for them to understand?
Currently our market cap is $40 million. We've signed up Societe Generale to provide $300 million of debt for the project. So we're working on that with them today. We expect that will get completed towards the end of Q3, Q4 next year. And then, our partners and our current equity partners, and we're out talking to a couple of interested parties in order to finalize the overall financing for the project, which is, as I mentioned, just a little bit under $500 million, subject to completing the final study that we need to do in the next couple of months. So I do think it's a great opportunity for investors to take a look at us. We have, a relatively low market cap in terms of, Canadian dollar, $40 million market cap. So we have a relatively low market cap for what we want to accomplish over time. And we really do feel like we can build a very large and successful company out of this project.
Well, thank you very much, Sean. I will put a link below in the description to the Strategic Resources website and social media profile for people who want to follow along with the company. Greatly appreciate you coming on the show and sharing your knowledge with the audience.
Thanks, Jesse.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.